Good afternoon, friends. I'm Sandeep Biani, heading business development and sales at AlphaCredit Advisors. It's my pleasure to welcome you all to AAA Investor Connect. Joining me today are some of the key leaders of AlphaCredit Advisors: Mr. Rajesh Kothari, founder and managing director of AAA; Mr. Govind Agrawal, director of investments at AAA; Mr. Yuvraj Nemade, head of Western Region Sales based out of Mumbai; Mr. Robin Chaudhary, head Northern Region for Sales based out of Delhi. A warm welcome to all of you. Friends, India's equity market are entering a powerful new phase of optimism, supported by a rare and historic alignment of macroeconomic factors. For the first time in many months, we are witnessing a potent combination of softening inflation, proactive monetary policy, and strong fiscal support, creating fertile ground for a broad-based economic revival. These favorable dynamics are not only boosting near term confidence, but also positioning India as one of the most compelling investment stories on the global stage. To help us navigate this evolving landscape and gain deeper insight into what lies ahead, it's my privilege to introduce Mr. Rajesh Kothari, founder and managing director of AlphaCredit Advisors. A highly respected voice in the investment community, Mr. Kothari brings decades of experience in navigating market cycles and identifying long term value. He will share his perspective on the emerging opportunities, the challenges that investor must be mindful of, and strategic imperatives for capitalizing on this exciting phase. Welcome, Rajesh.
Thank you, Sandeep.
Rajesh, we have many new investors joining us today who may be hearing you for the very first time. So I request you start your market outlook after with a brief introduction of our investment philosophy and style. Over to you,
Perfect. Thank you. Thank you, Sandeep. Good afternoon, friends. I think it is the Indian markets and also, of course, the global markets in last particularly 6, 9, 12 months, we have seen different phases. It started with a Modi ji election in May 2024. After that, it was a Donald Trump election, US market, September, October. Then we entered February, where tariff was started by Mr. Donald Trump. And then in month of March, we have a India-Pakistan Pahalgam attack. And after that, we had a again problem with reference to Israel and Iran. And then, of course, US entered Israel and Iran. And again, there was a switch off of that war, Israel-Iran. So the phases of volatility has become multifold compared to what we have seen historically. But before I talk about market, let me quickly, just in 2-3 minutes, a little bit summarize about a little bit about us, and then a little bit about philosophy and the process. So I am founder of this firm, AlphaCredit Advisors, one of the few firms in Indian PMS industry with a 15 plus years of longevity. That's something very, very important. We have a very strong team at the investment management side, total 8 members team, and 6 out of 8 members would have 10 to 20 years of experience, each of us. And that means combined experience of roughly 140 to 150 years. With that experience, what we try to gain an age over to probably any other firm is understanding a little bit, knowing a little bit better in what not to do. And I think that's something very, very important in equity markets. Our USP at the firm level is I'm founder and I'm fund manager. My personal money is also invested, same where my clients' money are invested. 100% skin in the game. We are not into any other business, so no conflict of interest. Longevity, which I already talked about. And last but not least, the award-winning track record. Our flagship PMS, which is called AAA India Opportunity PMS, has delivered 19% compounded annualized returns compared to benchmark returns of about 12% in last 15.5 years. And our AAA Budding Beast has delivered roughly 28% compounded annualized returns in last 4.5 years of its launch compared to BSE 500 index returns of roughly 18%. With that, we have been awarded as one of the best top 3 multi-cap PMS in India, 4 out of 5 years, by none other than PMS AI World in association with IIM Ahmedabad. We have a very strong business development team headed by Sandeep Biani and, of course, his colleagues in Western India, as well as in Northern India, and as well in South India. We have a very strong investor services program And of course, we have a very strong investor engagement program. So that's a little bit brief about our firm. As I speak with you, thanks to all our supports of all our investors and partners, we are roughly 3,800 crores in terms of assets under management, and we manage few very large family offices apart from ultra high HNIs as clients. Our investment philosophy is very simple. 4 words: protect capital and create wealth. Indian markets, being one of the fastest growing economy in the world, in my view, will keep delivering very strong returns to the investors. But the same equity market every year goes down by 10, 15, 20%. And in that bad times, how your product does is something very, very important for all our investors. And therefore, our first priority is to preserve capital. The protection of capital is the first utmost priority, and of course, followed up by the wealth creation. Our investment style is a little bit differentiated style, which is called cogility. It is a quality plus agility. We are quality conscious in terms of what we buy, and at the same time, we are agile enough to get out of it. As I always say, क्या लेना सबको पता है, कभी बेचना, that's where the art and science of fund management comes into play. So we are very, very focused on when to exit the stocks rather than just focusing on what to buy in the portfolio. We have a very strong 3M investment approach while doing the stock selection, which is called market size, market share, and margin of safety. We buy the companies which are industry leaders. We buy the companies supported by best of the management. We buy the companies provided they have the best of the governance. And of course, if they have the best of the financials. Once we buy such businesses at reasonable valuations, we monitor business cycles very, very closely. And whenever we think that the valuations are turning very expensive, we get out of them. Whenever we think earnings growth is not going to come or is likely to slow down, we get out of them. And whenever we think that we are probably going to go wrong in our assumptions, we get out of them, which is called 3R process internally. That is review, repair, and regenerate. We keep doing this exercise almost on a daily basis to ensure that none of our portfolio companies have a long-term punctures in the earnings growth in the foreseeable 4 to 6 quarters. That's how we build the portfolio. Without wasting much of time, let me straight come to today's very interesting topic, that how do we see the market from here on? And let me reconnect the dots where I left with my opening remark, that Indian markets and also the world equity markets has seen the unprecedented volatility, but more importantly, the series of events. At least in my 25 years of career, and I'm sure all of you would agree with me, in probably last 50 years, the 5 decades, we have never seen 4 wars ongoing. Like if you remember in month of April, I was opening Economic Times, and on the front page, there was a Russia-Ukraine war, which is ongoing from almost like 2.5+ years. We have a Israel-Gaza, which is continuing. We have a Israel-Iran, which happened in month of April. And then US joined that. So US against Iran. And of course, to a certain extent, India-Pakistan. 5 wars were ongoing in the month of April. And the global equity markets, not only US equity market, but also the most other global equity markets, they are positive. Who would have think that when the 5 wars are ongoing across the different continents, the equity market would be positive? At least I would not have thought so. If you would have told me 10 years back that, Rajesh, in April 25, you will see the 5 wars in 3 different continents, and still markets will be up, definitely I would be scared. But the reality has changed. And that's what I wanted to re-emphasize to investors. Because most of the time when I speak with all my investors and the partners, there's a kind of fear in the minds that what will happen to market? Markets ka volatility बढ़ रहा है. A lot of wars are ongoing and many more such factors. So noise has gone up significantly. And therefore, whether market will correct by 20%, 30%, whether we will get a better opportunity, maybe 15% correction, 20% correction, all these are questions in the minds of investor. But I always believe that one should not only look at what kind of events are ongoing, but one should also look at that what is the market is trying to convey to you. In Gujarati, they say Bhav Bhagwan che. In English, they say price is God. Stock price also tries to tell you something. And what is that something is basically what you need to gauge by years of your experience into the Indian capital market. If a question comes to your mind that there are 5 wars which are ongoing in the world, why the equity markets are up? The answer lies is that what kind of wars we are talking about. Is it a full-fledged war or is it a target war? What is the meaning of targeted war? Say, for example, when Israel attacked a particular place in Gaza, trying to remove maybe the terrorist as per their definition, that is called targeted war. And that's what makes complete difference versus the full-fledged war and the kind of a 15, 20, 25 days kind of a friction. And at the same time, what one also needs to understand is that how the world is responding to this war. When Russia declared war against Ukraine, what happened that everybody was scared because it's the first time that kind of a European friendly nation was targeted by Russia. But if you look at the wheat exports from Ukraine, it never stopped. If you look at the Russian crude oil exports to India and all other countries, it never stopped. If you look at the Russia gas pipelines to Germany, it didn't stop. What it means? It means that world is increasingly coming to the table to understand that there are some critical components of the economy which are required not to be disturbed. And if you look at Israel when it attacked Iran, there are a number of reports which came into the industry that crude oil price will go to $200 because that canal they will block. But it didn't happen. Why it didn't happen? Because that's what world wanted from Iran, that if you need to remain like where you are, you don't need to disturb that crude oil movement, because if you disturb the crude oil movement, the consequences will be completely different. You might be removed from the global map, maybe, correct? So what I'm trying to understand is that, and to convey, is that whenever such kind of news comes, of course, these are terrible news. We all are not accustomed to this news. But after 1 week, 2 weeks, 3 weeks, when you start getting the impact of that war, you will realize that the impact on economy is minimal. And when the impact on economy is going to be minimal, the impact on equity market also will be minimal. So impact will be there. Some price correction, some volatility bound to be there. But will market go down by 25%? Whether economic growth will collapse by 25%? Whether the earnings growth of the corporates will collapse by 25%? If answer to that question is no, then stock markets will not go down. And this is very, very important thing, because most investors today, the biggest concern is whether market will correct by 20-25%. And answer why market is not correcting despite most of this negative news lies in this effect on economy of these wars. And if the effect on the economy and the global GDP growth is going to be very, very limited, then markets will also not go down significantly. So this is a one very important thing I wanted to highlight you. And of course, second very important thing, what I believe that, what is going to happen to the market. And in month of April also, when we did this webinar, I told all the investors and the participants that we are very bullish on the market. And from there, of course, market started moving up. It's already up by 10-15%. Many stocks are up 25-30%. And if you ask me today, what is my view? We remain bullish on the market. And why we remain bullish on the market? Let me tell you that through few very important slides. Let me present it. Please give me one moment, and then I will talk about why we be so bullish on the market. Give me one moment. I hope this slide is visible to you. And the entire topic is when policy meets opportunity, Indian markets are ready for takeoff. Friends, remember that in month of from I think month of August 2024 to up to March 2025, we were a little bit cautious on the market. Many of you friends, they asked us, how should you invest? And to many of them, we responded that you can do STP, systematic transfer plan, particularly if you are investing into mid and small cap. And our actually view also went right, market turned more volatile, which gave some little bit better opportunity to average out your acquisition cost. But from month of March, we have actually changed that stance and we see now we are very bullish on the market. And why we are bullish is one very important things that what is happening in the Indian economy. Friends, if you look at the most important thing, which is very, very important for markets, is the inflation. And if you look at this slide, the inflation has reduced drastically. This is absolutely almost like crash of inflation, whether it is a CPI or whether you look at CFPI, both indices are significantly lower. If you look at interest rate, there is for the first time in last 5 years, probably, or maybe in last 10 years, except of course the COVID time, RBI did 100 bips rate cut announcement. Think of it, when you heard RBI doing 100 bips rate cut at one go. There is no such announcement, at least I don't remember in last 5, 7, 8 years, except the COVID years. So look at this interest rate and look at this movement, so this is a huge repo rate cut by RBI. And on top of this, RBI also injected 10 lakh crores into the liquidity system. And that's a huge number. This is something very, very important because after a very, very long time, we are seeing inflation is under control and RBI is taking a bold step of announcing 100 bips rate cut. If you look at the crude oil price movement, the 20 years average is roughly $72. And currently we are below 72. And with Donald Trump announcing drill baby drill, I do not see significant upside risk to the crude oil. Can it move to 75? It can move. Up to 75, 80, I think we are absolutely fine. Beyond 84, 85, that's starts a little bit kind of hitting to our economy. So crude oil is also under control. So when crude oil is down, the inflation environment looks favorable and the interest rates are also down. That tells you that the macroeconomic environment is going to become significantly positive over next 6, 9, 12 months. Typically, it takes 2 to 3 quarters for the macro action to result into the micro improvement in economy. And most importantly, now I'm coming to some very important thing is what is the government is doing when RBI is taking the bold step. This for the first time I'm seeing in last 10 years that the central ministry is also taking a very bold step of front loading the action plan. During FY25, when the budget got published in the month of February, the capital expenditure estimate was 10 lakh crores. And everybody was doubting that how government will be able to do it because there are only 3 months were left. Month of February was intention and in Jan, Feb, March, how much you can spend. But when the actual numbers came out, government actually surprised their estimates by spending more than what they budgeted for. Please remember that in FY25, for the first 7, 8 months, there are no significant capex because of the election issues. But government was able to do the huge spending in last 3 months and they have exceeded their own targets. Surprisingly, if you look at this number, this is very, very interesting slide. In FY26, government is targeting 10% growth in their capital expenditure numbers. But if you look at the month of April and May, they are front loading this capex spend. So April and May, which is typically 13% of the total capex, this time they have spent 19% of total capex. So RBI is front loading their action by doing 100 pips rate cut and by injecting 11 lakh crores kind of a liquidity in the system. Central government is front loading their action by doing the significantly higher capex in first 2-3 months itself compared to what they used to do it. And third, very important, I'm sure all of you remember that finance minister is also front loading her action by announcing the tax rate cut almost 1,20,000 crores of gift to the middle class of this country. And what does it mean? It means typically there is a 20% is a roughly savings rate. It means 80% is a kind of a spending rate, and it means a huge multiplier effect on economy. Of course, it takes 2-3 quarters by the time consumer gets that benefit of the income tax cut, and then the spending start. So RBI, central government, and finance ministry, all three, they are working together. They are doing the front loading of their action, and therefore the macro environment has never been so good. And in my view, that will result into significant improvement in the underlying Indian economy recovery, starting from probably third quarter or fourth quarter, and that will continue to lead for at least next 18-24 months of very good economic environment. Who was the biggest villain in last 12 months in FY25 was none other than our nifty EPS growth. Friends, after very strong earnings growth of 20% reported by Nifty in FY24, in FY25, earnings growth became significantly lower, just at 6%. However, I strongly believe that because of the front-loading of action by RBI, tax cut by finance minister, and also the capex significant increase by central government, we believe that the economic growth is going to improve. And from second quarter itself, that is starting from the June, July, August, we are already in June. June is already over, and now we already started with July. So from second quarter, that's this quarter itself, I expect the Nifty EPS growth to start improving. And we believe that the full year earnings growth will come back to its long-term 10-year average of roughly 12%. And if the EPS growth is going to improve, if the macroeconomic environment is in our favor, then definitely the market downside is going to be very limited. Tariff uncertainty, that continues, the biggest talk of the town. But as we, by every passing day, this fear is reducing, because ultimately is a rule of economics which matters. If India's positioning relatively is much better compared to China, I believe that the tariff will not significantly impact adversely to corporate earnings growth of our country. As you can see here, if you look at the China, Mexico, Vietnam, Taiwan, India is, in terms of the trade deficit, is significantly lower, and therefore that's our view that India will not be significantly impacted relative to other countries of the world. What does this mean for the valuation? That's the last thing which is most important, and this is the second most discussed topic with all my investors. The first topic, as I said, is that can market correct significantly because of the war and all such factor. And second factor, once they get convinced कि नहीं ठीक है बाजार ज़्यादा गिरेगा नहीं, the second discussion on, don't you think the valuations are already expensive? Answer is no. Valuations are not expensive. And look at this chart. What is a Nifty 10-year average valuations? Is roughly about 21 times. And what is a current Nifty PE? Is roughly about 22 times. Just 2-4% premium compared to 10 years average. So we are definitely not expensive. We are not cheap, but we are not expensive either. And also, I would like to break the myth that one should not look at purely on price to earning basis. What is most important is to look for any company, and for that matter, any indices on PEG basis. What is PEG? PEG is nothing but price to earning divided by the growth of that particular economy, or growth of that particular index, or growth for that particular company. Let's talk, for example, for the world market, number one country, which is US. And if we look at the US price to earning multiple, it's trading at around 22 times. And if we look at the US EPS growth, the S&P 500 EPS growth is roughly anywhere between 6 to 9%. Let's assume for the moment the upper side, the 9% EPS growth and 22 price to earning multiple. It means US is trading at close to 2.5 on PEG basis. Now let's compare this with India. Nifty is trading at roughly 22 times, and Nifty earnings growth is roughly 11%. So Nifty is trading at roughly 2 times PEG, which is absolutely fair, not at all expensive compared to any other benchmark in the world equity markets. And please remember, the underlying ROE of our economy is improving. Underlying balance sheet is becoming much stronger. interest rates are reducing, macro environment is turning favorable. If you put all these things in conjunction, then you will find that Nifty is actually available at a reasonably attractive valuation. And moment you enter in September, which is just 4 months away, everybody will talk about FY27 and with another 12% EPS growth. So in all probabilities, if you ask my personal view, the downside of the market is not more than 5, 7, 8%. But upside is going to be huge because we believe that the earnings growth is going to be 11, 12% for the Nifty. But of course, there are many, many companies in this country which are growing at a much higher rate. And therefore, if you select the stocks wisely, there is a reasonable amount of alpha what you can create for your investors compared to benchmark valuations. So this is my view on the overall market. Just to conclude, we are very bullish on the market. We believe that the macro environment has never been so positive. Lower inflation, lower interest rate, favorable RBI policy, favorable central government policy, favorable finance minister policy, and very importantly, support by government in terms of PLI, the China plus one strategy by the global players, the ongoing tariff war resulting into some benefit for countries like India, and last but not least, all these things resulting into better Nifty EPS growth, which we are getting at a reasonable valuation. And therefore, if anyone who has a 3, 4, 5 plus years of time horizon, we believe that equity as an asset class will continue to deliver and outperform most other asset classes in this country. So that's my final view on market. Be bullish and keep investing and keep adding to equity as an asset class. Now let me talk about a little bit about one very important thing which is happening in the market is about the business cycles. As you are aware that our investment style is, which I talked about, the causality is nothing but quality plus agility. Friends, I'm sure you would have heard from many managers and of course from many, I would say, stock market gurus that in the long term, markets are going to deliver fantastic returns and you will create huge wealth by holding the stocks for a very, very long time. But what has happened in particularly last 4, 5, 6, 7, 9 years is that the business cycles are reducing. They are getting shorter. The time frame of business cycles are getting shorter and they are becoming more volatile. And as the cycles gets more volatile, it creates huge opportunity for active fund managers like us to optimize on that greed and fear. On this particular slide, I wanted to showcase you that how the earnings growth of different indices, the entire sectors have performed in last 10 years. And I would also like to break the myth that there is something called consistency. In fact, the only consistency about consistency is inconsistency. And let me showcase you with one very important, the most defensive sector, which is called pharma sector. And I wanted to show you what kind of earnings growth it is reported across last 10, 11, 12 years. If you look at this slide very closely, in my opinion, anything less than GDP growth of the country is called suboptimal earnings growth. So India GDP growth, real GDP growth is 6% and inflation is roughly 5%. So nominal GDP growth is roughly 11, 12%. So this red line is 11%, 12% line. That's a minimum what we expect for any sector to deliver every year. But the so-called defensive sector, like for example, pharma, how many years they turn red? 1, 2, 3, 4, 5, 6, and 7. 7 out of 13 years, pharma sector reported earnings growth less than GDP growth. So-called secular, so-called defensive sector for the across the world market, pharma is called the most defensive. कि अगर ये pharma sector तो every साल 11, 12, 13, 14% profit growth देते ही रहेगा, and therefore stock price will also keep delivering 11, 12, 13%. But in reality, that is not the case. 60 to 70% of the time, pharmaceutical sector reported profit growth less than GDP growth, and therefore, if you look at this very important slide, that if you look at the index performance, if one would have invested in pharmaceutical index, there were many years where pharmaceutical sector reported very subdued numbers like -2, 11, -17, only 4%, and numbers like this. So there is nothing called defensive, there is nothing called secular. Every business goes through the cycles, and as a fund manager, our job is to identify the inflection point of that cycle, buy at right time, monitor the cycles, monitor the growth, monitor valuations, and get out of it at right time. Let me highlight the second most defensive sector, which is so-called defensive, is consumer sector. And here again, if you look at this, the red line is nominal GDP growth of the country. And this bar chart shows you that how many times, how many years consumer sector reported growth higher than GDP growth. In fact, it is only 1, 2, 3, 4, and 5. Only 5 years out of 11, 12, 13 years, consumer sector delivered growth better than GDP. In all other years, in fact, the GDP growth has done far better than consumer profit growth. And therefore, if one would have invested in consumer index, then there are many years sector delivered -13, just 11, -37, only 9%, and only 10% market cap returns to the investors. So what I'm trying to convey is that the business cycles are getting shorter, and therefore our strategy of focusing on discipline exit strategy comes very, very handy. We keep implementing it to the best of our possible efforts, trying to identify the businesses at the right point of their business cycles and capitalize it as best as possible. With that, let me now shift to how exactly we have implemented this, our causality, the rotation of the various sectors in our both plan, AAA multi-cap IOP PMS, as well as AAA budding based mid and small cap PMS. And friends, this is a slide in front of you. This is the last 5 years. And if I just take 2 minutes to explain this chart in front of you, this is the automobile sector. I'm sure you remember COVID wave phase 2, which started in February 2021. Auto stocks corrected, and we took that as an opportunity to build the auto sector weightage. We started with 7%, and we kept adding to auto sector to almost 10% of the portfolio. After we invested in auto sector, what happened to the auto index? Index went up by almost 100%, then 8%, and then 17%. And then slowly, in the last June 2024, when there was a euphoria, we started booking profits. And from 10%, we reduced the exposure to 7%. And as you can see, the auto index also reported kind of a very, very moderate marginal negative returns. So that's how we kept changing our exposure to auto sector across different time horizons. Similarly, capital goods, we were probably the early one in identifying capital goods as a theme. We started taking the engineering exposure, 9% of the portfolio, way back in 2021 when nobody was talking capital goods. After that, index went up by almost 92%, then 30%, and then 25%, and then 77%. And that's where we started booking profit from 13, 14%. We reduced the exposure to almost 8% and further to 7%. As I said, if that is too fast, too soon, if the valuation turns expensive, we keep doing profit booking and keep exiting and reducing our exposure. And same thing in pharmaceuticals. In pharma sector, during COVID time, we have a very large exposure, which we made almost zero exposure. And from zero, last 18 months back in March 2024, we started increasing the exposure to almost from 0 to 9%. And look at the index performance. Index is almost 60%. And same thing for software. During COVID, we took the exposure, increased the added exposure to software sector. Software sector did extremely well. And then when Russia declared war against Ukraine, we realized that US economy will not do well. And since IT sector is linked to US economy, we reduced the IT sector weightage almost by half, from 13% to 7%. And as you can see here, IT index also registered 21% decline. So I just wanted to basically showcase you how we are implementing what we are talking about active sector strategy, the active cycle aware approach. Coming to how our portfolio performed in FY25 and in the fourth quarter FY25, which is something very, very important. As you are aware, Indian economy was going through slowdown phase during FY25. If you look at the Nifty revenue growth and the Nifty profit growth, it is muted, very low single digit, 7% revenue growth and only 6% profit growth. Against that very challenging times, I am very pleased to share with you that our portfolio delivered 17% revenue growth and 21% net profit growth. This is something very, very important because I always believe that if the input is strong, the output, that is performance, by default will become strong. So this is a performance despite a challenging phase of Indian economy. Our portfolio companies delivered very solid growth, 21% profit growth, not only for FY25, but also when you look at the fourth quarter, our portfolio companies delivered 20% revenue growth and 23% profit growth. In terms of quantifying the quality, how our portfolio live characteristics are, as you are aware, AAA IOP is a true multi-cap. Average weighted market cap is roughly 4,25,000 crores, which gives you some indication of what kind of companies which we are buying. Pretty reasonably big companies, that's what we buy. Roughly 50% large cap and 45 to 50% is mid and small cap. But very importantly, all my portfolio companies, they are large by profit size. In fact, 2/3 of the portfolio companies, they are 500 crores plus reported net profit after tax. And this is something very important to note, that if you select the companies where profit size is pretty large, that brings resilience to that company. And when you buy such resilience, it means if there is a macro uncertainty like crude oil volatility, currency volatility, geopolitical volatility, the company will be able to withstand and will not be impacted significantly because of such outside storms in the world market. So most of the portfolio companies, they are large by profit size. While 45 to 50% is mid and small cap, what this means is that we do not have any single small company by profit size in our portfolio. All our companies, they are large by profit size, but as per regulatory definition, only top 100 by market cap is called large cap. And therefore, while the companies might be tagged as a mid and small cap, their profits and their revenues and their market share, they are market leaders, irrespective of their market cap in their respective category. In terms of the balance sheet, most of the portfolio companies, they are either debt-free or they have a under-leveraged, less than 1 time debt to equity. They have a very high ROE, and very importantly, they have very strong earnings growth. Coming to AAA Budding Beast, in terms of the fourth quarter FY25 numbers, which just got announced, compared to Nifty, just like in IOP here also, our portfolio delivered very, very strong revenue growth and very, very strong profit growth, 23% revenue growth and 24% profit growth, compared to Nifty revenue growth of 7% and Nifty profit growth of only 6%. In fourth quarter FY25 as well, our Budding Beast delivered 21% revenue growth and 22% profit growth. In terms of live characteristics of Budding Beast portfolio, as I keep saying, AAA Budding Beast is probably India's one of its kind mid and small cap PMS, which is called mid and small, but actually it's a strength of large, because irrespective of the market cap, all our portfolio companies, they are large by profit size, they are market leaders in their respective industry, they enjoy the under-leveraged balance sheet, they enjoy high pricing power and therefore high ROE, and most importantly, they have a very, very strong high earnings growth. So this is the live characteristics of AAA Budding Beast. Both these portfolios, they offer the best of the market leaders, best of the balance sheet, best of the governance, and of course, very strong earnings growth, significantly higher than the Nifty earnings growth, which creates a scope for significantly huge wealth creation for our investors. In terms of currently how we are positioned in terms of the sectoral allocation, let me just spend 2-3 minutes on that. So this is how the sectoral exposure currently looks like. Banking and finance is 29% of the portfolio. Here we own corporate banks, we own NBFCs, we are very bullish on housing finance companies, and one or two insurance companies. That's what we own within banking and finance. Software, we have reduced the exposure. Earlier it was 11%, which was reduced once tariff uncertainty started in month of February and March. Currently we are holding roughly 9%. Pharmaceutical is another 9% of the portfolio. Here basically what we own is Indian domestic oriented pharmaceutical companies. We own CDMO. CDMO is one space which we are very bullish. We are holding from last 3-4 years. And we also own hospitals. Capital goods is 9% of the portfolio. And here in capital goods, what we own is companies which are focused on the new growth drivers like data centers, robotics, automation, and the companies which are going to beneficiary from that side. Specialty chemical is one segment which we added our exposure, particularly in last 12 months. I'm sure many of the participants might be even old investors in the last 5-10 years. And if you remember, in 2018, probably we were one of the first to buy specialty chemicals. By March 2023, it was almost 9% of my portfolio. And in March 2023, we made specialty chemicals zero. Why we made zero? Because China was opening up. Most of our portfolio companies, they become 3, 4, 5 times in 4-5 years. The valuation ballooned from 30 times to 40, 50 times. And we said this is not going to sustain, because if the China opens up, the chemical prices will come down and the earnings will also come down. Post our exit in March 2024, most chemical stocks, March 2023, most chemical stocks came down by 20, 30, 40%. And last 6, 8, 9 months, the valuations turned extremely attractive. India started putting the anti-dumping duty on Chinese products. At the same time, USA has also started putting anti-dumping duty on Chinese product. And at the same time, the EU, the European Union, also started doing the same thing. What that resulted into stoppage of dumping by the Chinese players on one hand. And on the other hand, there are a few very good companies which we always used to like. Their capex program, good part of capex is over. Of course, they are keep adding to their capex, but good part of capital expenditure is over, which results into lesser pressure on fixed cost and therefore the better revenue growth, resulting into better profit growth. So chemical is one sector which we added back, roughly right now 7% of the portfolio. And then auto is roughly 6%. Telecom, we own largest Airtel company in our portfolio apart from Indus. And then there are others. Here we own exchanges and we own the platform companies. So this is basically the overall how we are positioned in terms of our sectoral outlook. When it comes to the earnings growth and the valuation of AAA IOP, compared to Nifty earnings growth of only 12% in FY26, we expect our portfolio to deliver 25% plus earnings growth in FY26. On valuations, our valuations are quite reasonable. Against Nifty PEG of 1.89 times, our portfolio is trading at roughly 1.25 PEG. So while on PE, it seems a little bit higher, but the right way to look at it is on PEG basis. And on PEG basis, if you look at our portfolio, it is trading at a very, very reasonable PEG of only 1.25 times on FY26. Moment you look at FY27, this is what happens. If your portfolio is a high growth portfolio, just look at the effect of that for the next 12 months. Your PEG drops from 1.25 to just below 1, whereas the Nifty PEG still is 1.28. So you can imagine you are buying, let's assume one company, which is market leader, debt-free balance sheet, 18% ROE, return on net worth. And if you're buying that company on 18 months forward basis at below 1 time PEG, that's actually very, very attractive valuation. So, and there are enough opportunities in the market which are growing at a very healthy rate of earnings growth of 15, 18, 20% plus. In terms of the performance, let me show you the AAA IOP performance. Before I talk about alpha, let me talk about the drawdown, because acid test of any fund manager is how he performs during bad times. And as you can see here, every year market comes down. There is not a single year when market don't go down. But the blue bar, which is AAA IOP, of the fall is always lesser than the gray bar, that is BSE 500. Including COVID times, where our fall was lesser, Russia-Ukraine war times, our fall was lesser, the recent January correction, March correction, our fall was lesser. 16 out of 18 such volatile periods, our portfolio performance has outperformed during the bad times of the market. If you look at the September to March collapse of the market, again, against the drawdown of 35% of most stocks, the average BSE 500 stock, our fall was almost half of it, just 18%, compared to average stock down 35%. In terms of compounded annualized returns, last 15 and a half years, 18.7% compounded annualized returns compared to benchmark returns of 13.1. And these are performance 1 year, 2 year, 3 year, 5 year, 10 years, and since inception. If you look at FY25, the year which went by, against just a kind of a low single digit market returns, we delivered 13% positive returns, very healthy double digit returns to our investors. In terms of the risk analytics, beta of the portfolio is less than benchmark with a very high Sharpe ratio and very strong rolling returns across the different time horizons. Let me quickly take you through AAA Budding Beast update in terms of the how we are positioned. Here, banking and finance is 15%. And as you look at this, just 1 year back, the weightage was only 7%. From 7%, we've increased the weightage to almost 15%. Within banking and finance, what we like is the housing finance is one space which we like the most, which is a very high weightage within banking and finance. If you look at the chemicals, from almost 0% portfolio exposure in March 2024, here we own roughly 10% of the portfolio in specialty chemicals. You have identified many opportunities. All these companies are market leaders. And as I said, they are a huge beneficiary of anti-dumping duties, which has been imposed by the world markets on Chinese players, as well as few of them are very niche companies, which have done significant capital expenditure, and they are the biggest beneficiary of the CDMO and other such contracts, which they can receive from their global customers. Consumer is one sector which we have reduced the exposure from 10%, almost like 15, 18 months back, to less than 5% as I speak with you, because the Indian consumer was impacted significantly, and therefore we reduced the exposure throughout last 2-3 quarters. EMS is one space on which we are very bullish, and we own 3 companies in EMS space, roughly 6% of the portfolio, and we believe that the government efforts of making India is going to become the biggest tailwind for most EMS companies in our country, and that will result into very strong, healthy earnings growth of 25 to 40% for most of the companies within the EMS space. Capital goods is one sector which we continue to like, although because it went up significantly, we did some profit booking, but still, nonetheless, we are roughly 15% of the portfolio in capital goods. In pharmaceuticals, as I talked earlier, we have increased the weightage. 18 months back, we were almost like 0, from 0 to 6, and 6 to now almost 14% of the portfolio in pharmaceuticals. Within pharmaceuticals, what we own is hospitals. Very large portion of the portfolio is hospitals. And we also own one very unique opportunity, which is the best beneficiary of anti-obesity drug, the GLP-1 is the biggest beneficiary of this anti-obesity drug, is a large portion of our portfolio. Software, very low weightage. We remain underweight on software, roughly 5%. And platforms we continue to like, roughly 2% of the portfolio is platforms. So this is how the entire Budding Beast portfolio is positioned for. In terms of the earnings growth and valuation, our portfolio, we are expecting very strong earnings growth of 30% plus for FY26 as well as for FY27. And if we look at on PEG basis, it trades at very attractive PEG of 1.29 times compared to Nifty PEG of 1.9 times. And if you look at FY27, very strong earnings growth, very high ROE, and a reasonably strong attractive PEG at just one time compared to Nifty PEG of 1.28. Last but not least, in terms of risk analytics, as you can see here, the portfolio performance since inception of 4.5 years delivered 211% absolute returns compared to benchmark BSE 500 returns of 114%. In terms of the compounded returns, roughly 29% compounded returns since its launch on 1st January 2021 compared to benchmark returns of 18.4. But very importantly, even in years like FY23, when markets were negative, we delivered positive returns of 8.1. And in FY25, when market delivered low single digit number, we delivered healthy double digit 16% returns to our investors. Beta of this portfolio is less than benchmark, and it means the lower risk compared to the market. So, this is about the overall update. Of course, AAA India Equity Fund is our AIF, which is a category 3, is a multi-cap open-ended AIF from our side. And that portfolio has also delivered, just like our AAA IOP, 20% plus revenue growth, 20% plus profit growth, and of course, very strong, healthy returns to our investors. So, that is about AIF. Let me just share with you the slides of the performance of AIF as well. So this is 24% compounding. It was launched on 16th May 2023 compared to benchmark returns of 23%. So just a minute. So that is basically as far as AIF portfolio goes. So that's it from my side. And just to conclude, we are very positive on the market. We believe that Indian market provides unique opportunity to investors. We are getting the revival of growth thanks to the better positive macroeconomic environment, and the valuations are quite reasonable. Of course, unlike 2020, 21, and 22, when it was a throw the dart, make the money, it is not going to be so easy. Cycles are getting shorter every day. Name of the game is bottom-up strategy. Alpha fund managers definitely will be rewarded. You need to select the right company. Don't fall under the trap of greed, making sure you are buying best of the businesses at a reasonable valuation. And that's what we keep doing it. Keep monitoring cycles and keep exiting. There are many companies, which we exited in last 12 months, wherever we saw that opportunity has come to do profit booking, because many of these companies went up through the significantly higher valuation. And at the same time, there are few companies which we exited because we thought that our underlying assumptions are not going to go right because of the changed global environment, particularly because of the tariff environment in USA. So we always keep adjusting and keep aligning our portfolio depending upon how do we see the growth outlook over next 12 to 24 months. So this is about both the portfolios, overall portfolio strategies. How do we see that? And very importantly, how they have performed in terms of the earnings growth throughout very challenging time of last 12, 18 months. And how do we see their portfolio earnings growth over next 12 to 18 months. With that, I think we can open up for question and answers. Just a last line from my side. We have added a very strong team in Delhi and of course in Mumbai. And if you have any queries, you can always reach out to our respective locations. We have a digital onboarding, a physical onboarding, best of the investor engagement program, and best of the client services. We have a SIP options and HTP options in our PMS, with the Deutsche Bank as a custodian and fund accountant, and HDFC and stock holding as our DP participant. With that, I would like to open up for Q&A. Please feel free if you have any queries. Thank you very much for hearing us out very patiently, and looking forward for active discussion. Thank you.
Thanks, Rajesh. Participant requesting everybody, please post your questions in a Q&A section or in chat box. Requesting everybody, please post your questions in Q&A section or even in chat box. Thank you. Rajesh, till the time the questions get assembled, a couple of questions also. Considering the global geopolitical risk, how you look at the sectors like IT and defense? Because IT is not performing in recent times. What's your take on that?
Well, you are right. So, what happens is the IT sector, the fortunes are linked to the particularly the US economy because our biggest customer is US. And when the US is going through a little bit kind of a, I would say, uncertain environment, the IT sectors, the particularly the discretionary spending within IT is going to take a backseat. And that's why if you look at the IT stocks also, they are not performing, particularly in last 3-4 months. Our portfolio exposure is also we are underweight compared to benchmark. So we are also playing a little bit kind of a cautious on IT sector. Having said that, one important thing which I wanted to highlight is that if you look at Accenture, the global company has announced its numbers, a few weeks back, and we were hearing his conference call. What we understand from the global companies is that they were also passing through these uncertain times. So in month of February, post tariff war, March was like complete halt on any decision. Everybody was in a shock of tariff shock. So as a global IT spender, as a global company, they decided not to do much unless it is something which is very, very essential. You need to do it. Otherwise, don't do it. But as the months progress, the time passed, the April, May, June, they have now realized that this is the reality. Uncertainty is the new normal, but you cannot postpone few large investments, particularly related to AI related investments. And therefore, if I hear that conference call, of course, there are many other companies which are yet to announce numbers, and we'll be hearing them, very, very monitoring them closely. What is their take? I'm talking about the global IT companies, not the Indian IT companies. But what I understand from that in a very, very limited way is that the AI spending is going to come back because if companies keep postponing their AI spend, then they will lose out edge somewhere. So I think it is going to be a very, very interesting space. We are going to monitor it very closely. Maybe by second quarter, third quarter, it will bottom out and AI spending will start going up. In fact, if you look at even the numbers of India's largest IT company, which announced numbers, 3 days back, TCS, while the revenue growth is not so strong, but if you look at their recruitment has actually increased. So if you look at the total salaries cost has actually increased. What does it mean? It means that Indian IT companies also realize that if you need to gain the volume growth and the revenue growth at a future date, you need to invest in the right talent. And that means even if there is a dip in margins the short term, maybe for 1 quarter problem, 2 quarter problems, but you need to hire the right talent. And therefore, we are now focusing not on number of employees. That doesn't make very important thing, but very important to look at the total salaries cost. Is it going up? In fact, if it goes up, it's not bad, it's good because it means the company is increasingly positioning itself to cater to the AI type of requirements. Because if I read the yesterday's Gartner IT report, the AI related spend, the data center related spend is going to be very, very strong, healthy, double digit, anywhere between 15 to 30%. So I think what is going to happen, coming to your question, what we are doing in IT. So right now we are underweight in IT sector across our portfolios, but we are monitoring this space very closely. Within IT, what we are going to do is that, like for example, in our multi-cap portfolio, we have a Coforge. Coforge is our largest exposure for last almost 3-4 years. And it's the best performing IT company in terms of profit growth. And of course, the best performing IT company in terms of even market cap returns. So any company which will invest into the growth, which will invest into the right, mergers and acquisitions, which will invest into capabilities and technologies related to the new technologies, those companies, in my view, will outperform the otherwise generic IT industry growth. That's my basically final view. So it's going to be bottom-up strategy within IT. So that is your first question on IT. Second question was defense.
Yeah.
And let me be very, very honest with you that we missed the defense bus, particularly in last 3 months. In fact, we were holding the good defense in our portfolio throughout 2022, 2023, 2024. And in June 2024, almost I would say at the peak of their valuations and the stock prices, we made it zero. So we were holding Bharat Electronics, we were holding Hindustan Aeronautics, all these companies we were holding. Why we reduced or exited in June 24? Because of 2 reasons. First reason, of course, the valuation went up through the roof. Modi ji won the election, so entire PSU went up. All these companies also went up. And secondly, there were significant delays in the orders, order announcement, as well as order execution. In fact, if you open up a company which is called Bharat Dynamics, and if you open up the results till September 2024, almost every quarter, they missed the street estimates, not by 2%, by 20%, because there was a shortage of the critical components because of the Russia-Ukraine war. And therefore, we exited, of course, after booking huge profits. And then nothing was happening up to, I think, month of March. And in the month of March, Pahalgam attack happened. And that's where the defense stocks came into limelight. But that was just a one point. After that, what happened? Other war also started globally, geopolitical problem. And that resulted into, that, okay, this growth can be much bigger, it can be much stronger, and the longevity of growth has increased post entire world entered into one or other types of war. So all of a sudden, everything moved by 50, 60%. But we were not into that, what I would say, very, very short-term thing. So to that extent, I would say that we missed the, defense as a space. But of course, we had many other things to, so no regrets because we had other sectors and other opportunities to bank upon. So that's my, so currently we are not holding any significant exposure to defense. In our budding list, we own one or two companies in defense. In our IOP, we do not have much defense. At right point of time, at right valuations, we'll reevaluate and we may add some positions in defense.
Sure. Thanks, Rajesh. The next question is from Mr. Abhishek. What do you think about white good industries, especially companies like Voltas and Whirlpool?
Hi, Abhishek. White goods companies is a very large space. There are multiple sub-segments within that. Air conditioning is one segment, washing machine is second segment, other consumer durable like kitchen appliances is third segment, and likewise. But the biggest segment, apart from these three, is the component segment. So we are very bullish on the first, the component segment, because on the white space, what is happening is that 2-3 things are happening simultaneously. One, the Indian consumer was a little bit under stress. Therefore, the overall industry growth is not very high double digit. It is like single digit growth. Within that single digit growth, the competition is becoming intense. There is a fierce competition. On one side, there is a Korean two giants, LG and Samsung. On the other side, there are established Indian players, which is like Voltas, Whirlpool, and the companies like that. And on the third side, there is the emergence of the new sector, new players. Like, for example, Tata Chroma, for example, Reliance Retail. They started their own air conditioning in their stores. And there are Amazons of the world. They also started selling through e-commerce. All of a sudden, there is a new competition to the established players. So there are three things. One is the old Korean players. Second is the domestic players existing, and third is the emergence of new players, including Reliance Retail, including the private label brands, including the Amazon, including the e-commerce. And therefore, we believe that the growth of the companies within this consumer durable space is going to be limited. Because even if industry grows 12%, because of the fierce competition, we don't know which company will gain market share versus A versus B. Within that, if you look at the air conditioning segment was doing extremely well. But because the early monsoon, probably for the first time, the monsoon came in month of April and in May itself, which has never happened, I think, in the last 10 years. Now, of course, the AC sales also got impacted. So what we are doing in our portfolio, first, we currently, let me talk about AAA IOP first, our multi-cap product. There, basically, what we own is company like Dixon, which benefits irrespective of whosoever gains the market share. So whether Whirlpool gets market share in washing machine, or Voltas Beko gets market share in washing machine, whether Motorola Mobile gets market share or somebody else, Dixon is going to be the biggest beneficiary, just not because of presence in one segment, multiple segment presence. They are the largest producer of TV, they are largest producer of refrigerator, they are largest producer of washing machine, they are largest player of mobiles. Now they are going to become the largest player of laptops, and so on and so forth. So that we continue to like Dixon as a company. In our AAA budding list, also what we own is the EMS players, and few of these EMS players, they are basically the component players. On top of it, there are few segments within white goods on which we are, what I would say, been bullish for quite some time. For example, water purifier. This is a segment which we are very bullish because here the competition is very, very limited. Unlike refrigerators and washing machine and TV, LG and Samsung, the two largest Korean players, They are absent in water purifier. So we own Eureka Forbes, the largest player in largest player in water purifier. The penetration of this category is one of the lowest, and the market share dominance is very, very high. Competition is very, very limited. The TAM is not so big, so LG and Samsung probably are not entering into this because it is not 1 lakh crore market. For them, that's kind of a benchmark number. And post our purchase of Eureka Forbes, I think about 2.5 years back, when there was a change in management, stock is done extremely well. They kept delivering the best of the earnings growth and best of the revenue growth. So this is my, in nutshell, view on the white goods space in our portfolio.
Thanks, sir. The next question is from Hinan Akpal. Given Trump's latest threat to levy tariffs on economies dealing with Russia, if Russia doesn't end the war with Ukraine, do you think India will find an alternative supply source? And how is that likely to impact our macros? I think,
Yeah. So, hi, Hina, how are you? See, one very important thing, the risk factors always are there, correct? There are always risk factors. What if, correct? And on what if, what is the probability of what if? So Donald Trump has basically, his belief strength brings peace. That's his open statement, right? So he did something with Iran, and matter of 3 days, then he says that he is my best friend, am I right? So that's how aggressive, and the change of stance means the most unpredictable, probably president the world is still till now, but that's a reality. And I think therefore everybody understands that this all kind of this what I would say warnings and these fears, and if he does it, whether he do it for 24 hours or whether he will do it for 5 years, nobody knows. And beyond a point, people have said, okay, we don't care. You do it, we'll see as it comes, correct? And same approach, I think the even India as a country is also taking. I'm sure there is a lot of what I would say diplomatic discussion which are happening, behind the curtains, and I'm sure we will able to find some solution. But if you ask me that, let's assume that everything gets cut and India doesn't get Russian crude, what happens? Of course, the crude oil price will go up. Now, same thing happened when the Israel-Iran happened. The crude oil price went up. But next question is, will it sustain to that high level? Now, let's assume if it sustained for that high level, entire world inflation will go up, correct? And if the entire world inflation will go up, US also will not be spared. And if the US inflation also goes up significantly, then US interest rate will also go up. And if the US interest rate also goes up, then Donald Trump doesn't like it. So he has to address it. So I think, you cannot do something which is irrational for a longer time period. Can it impact market for 48 hours, in 72 hours, or 1 week or 1 month? Possible. When Russia-Ukraine war happened, market went down 9% in a matter of, I think, 60 days. But after that, somebody who decided to hold on, not to do panic, after that market went to all-time high. So such events can happen. But in my view, whatever we have seen in last 6 months or 4 months in particular, I think those are the worst months, which nobody could have thought. Am I right? So from there to here, things are not going to be probably as worse. And if it happens, maybe it is going to be for a very, very short time. Equity investment is anyway for the longer term horizon. So you need to have a 4 or 5 years of time horizon. Volatility, take it to you as a friend. If such opportunity happens, use it with your both of your hands. But probability of such things probably is very, very low, if you ask my personal view. But who knows what's in store in future?
yeah. Thanks. The next question is from Mr. Bhaskar Ravi Ranvirkar. What are your views on the textile sector as India signs FTA? Are you looking at a sector leaders or like a portfolio?
Yeah, so I think textile sector is going to benefit, post these FTAs. But let me tell you, with our discussions with most of the textile companies, it is not going to happen very quickly in terms of the one is signing of FTA, and second is signing of FTA will happen, but the actual benefit takes 18, 24, 36 months. So anyway, it is a 1 to 3 year journey. It will not happen in a matter of 1 month. We'll start getting the orders. No, life doesn't work like that. So yes, of course, the narratives gets built and stock price goes up, but actual underlying is a very, very slow process. So it's a structurally positive for Indian textile sector, but it takes time to fructify for the numbers. So we are monitoring that space very closely, as you are aware. In our budding beast, earlier we used to own KPR mills, which we made huge good profit. We exited KPR mills and we bought then Gokuldas Exports. whereas India is one of the largest textile player from this country, and probably companies like KPR or Gokuldas and other 3, 4, 5 companies, definitely they will benefit significantly. The opportunity in EU in particular is very large. EU is a very big market. Until now, India is at a disadvantage because they give favorable treatment to Pakistan and Bangladesh, whereas India is not right now not getting same duties. So once FTA gets signed in EU, which I think is possible over next 6, 9, 12 months, Indian companies will get a new opportunity to cater to EU market, and that definitely will add to the growth. But as I said, it takes a little bit time because you need to recruit right workers. The workers needs to have the right skills. It takes anywhere between 12 to 18 months to get your desired skill levels. Means एक shoot आप देते हो, एक garment देते हो, तो garment number of garments to be stitched, it also take time. Correct? A lot of training programs get involved. You don't get labor so easily. Entire south is full. Tirupur, they are running choco-block. So therefore, increasingly companies are shifting to the north and Bihar, UP. These are the new markets which they are developing. Of course, there it is the first time, so it takes long time to get the desired productivity. So net is a positive, but earnings will take a little bit time. It will not happen on immediate basis.
Okay, thanks. The next question is from Mr. Abhishek Lal. How do you view the current trends and future prospects of the banking and NBFC sector?
Banking and NBFC sector, with the lower interest rates and the easy liquidity situation, the banking and NBFC sector will do reasonably well. What is going to happen is going to be divided in two halves, the first half and second half. As you are aware, when the interest rate goes down, if you are a bank, your pass-through is your asset liability mismatch, am I right? And therefore your net interest margins goes down. And as your net interest margin, because fixed deposit, you need to cut rate on immediate basis, correct? But or your yield to your borrower, it takes time to pass through that. 2 quarters, 3 quarters, 6 to 9 months. And there was a delay, there is a gap, there is a time gap. And because of the time gap, your net interest margin comes under pressure. And therefore, for the banks in particular, the first half is going to be soft. But the second half, as the transmission time lapses and finally both matches, the yield and your cost both matches, and therefore from third quarter onwards, the net interest margin will come back to the normal levels. If you look at on the NBFC side, on the other hand, particularly commercial vehicle financiers, the effect of passing on your borrower is almost immediate. Also, NBFC takes loans from the banks, and therefore for them, the cost also reduced immediately. And therefore, for NBFC in particular, the net interest margin will not be impacted so much compared to the banking sector. And therefore, if you look at our portfolio, we have very large weightage on NBFC, for both IOP portfolio as well as for my budding based. Within NBFC, commercial vehicle finance companies are the least impacted because of the NIM margin, NIM pressure. We have a Cholamandalam and Shriram Transport in our portfolios. Same thing for our budding based. So that's net view. Last but not least, something very important for the banking sector is the ultimate improvement in credit growth, which is right now little bit soft, which we expect that as economy enters into little bit better growth environment, from the third quarter onwards, we see pickup in the corporate credit growth as well as pickup in the retail credit growth. So overall retail growth is also likely to improve primarily in second half. Net interest margins impact also will get a lesser problem in the second half. And therefore, when you look at from the 12 to 18 months perspective, we believe that banking and finance companies will do reasonably well.
Okay, thanks. The next question. USA imposing tax tariffs on China and its economy slows due to the same. Is India going to get benefit out of it? How is India placed to grab that opportunity? I think, Govind sir?
Yes.
Govind sir,
So yeah,
I'll just
sure.
read it out again for you. USA imposing tax tariffs on China and its Economy slows due to the same. Is India going to get benefit out of it? How is India placed to grab that opportunity?
Okay, so there are two parts to this question. One is the uh, tariffs are being imposed on China and economy slows down. So if you see the news flow, the stance of Mr. Donald Trump is changing practically every day, every week. Latest is if you see, he had imposed tariff on rather restrictions on the exports of AI chips, and just day for yesterday, he has allowed two companies, Nvidia and AMD, to export this. So it's very unpredictable that the exports restrictions will remain there. But having said this, the China is not slowing down. If you see Q1 and Q2 GDP growth is more than 5%, while IMF and World Bank are expecting around 4.5%. So because of the stimulus, the China growth remains quite healthy at around 5%. So that's part one. Second part, whether India will benefit from this. So India, in any case, is getting benefited not just because of this tariff, but more because of the global companies have realized the risk associated with sourcing most of their material from China, and this started after 2018, when that's where China plus one term got coined, and this has only been increasing. And if you look at one sector which stands out, it is the electronics manufacturing, and you know the numbers. It is increasing every quarter and every year. India has emerged as a large exporter of electronics goods. So there is what is called as the de-risking. Most multinational companies who were sourcing 60, 70, 80% of their, whether it is components or the finished products or other raw material, they have started to move a part of this to other countries, and India is benefiting significantly from this. So I think this trend is likely to continue and maybe accelerate. And if Mr. Donald Trump continues with the tariff, which Rajesh highlighted, India relatively better placed, then from that perspective, India's exports will also increase relative to the other countries. So I think net India remains beneficiary, not so much because of the tariff which is being imposed on China, because who knows, after 1 week or after 1 month, things will completely change, because China is, as Rajesh also mentioned, because it is negotiation is basis on the strength. So China is able to negotiate very strongly based on their strength. So things can change very dramatically after a week or maybe a couple of months time. But India on a secular basis is getting benefited because of the de-risking by the many multinationals.
Thanks, Gunjan.
To add to that, and I think this is very important, in my all interactions, this question keeps coming up, that, the geopolitical situation, the tariff situation, because it's a front page, and CNBC also flashes probably 3 times in a day. And every day, Donald Trump, as Govind has also talked about, he changes his stance every day. So it creates more noise. And therefore, we keep telling to investor that, reduce noise as much as possible. Because one noise, and suppose you postpone a decision, and tomorrow it is a different decision, correct? And again, what is most important is that on this volatility, our portfolio positioning is very important. See, ultimately, we all need to focus finally how we make money out of all this uncertainty, out of all this chaos. Chaos is ongoing, but markets are already up 15%, correct? So India net, just to conclude, from all this entire tariff war, will it impact the world economy? Answer is yes. How much it will impact the world economy, no one knows. But considering it is in self-interest of Donald Trump that he will not do something so stupid that it will impact the US economy growth badly. That's the common sense which prevails. Am I right? And third, importantly, if there is going to be chaos in the world economy, whether India will benefit out of it, answer is yes. How much? Forget, we don't know. Nobody knows how much. Am I right? So net from the Indian equity perspective, moment you take 12, 24, 36 months view, not 10 days, 20 days view, but 2, 3, 4, 5 years view, is it important? I don't think so. Because Indian companies, our import dependence is very low. Our export dependence is very low. We have a very strong domestic resilient economy. We have the best of the demographics. Our corporate balance sheet is now deleveraged. So we do not have even the risk of that, okay, we have a huge debt. So how will we cater to the debt as a corporate India? We don't have that. Correct? So possible. Let's say the market doesn't do well for next 12 months. Okay, fine. After that, what? So moment you take 3 years view, this all of a sudden this noise value impact of that goes down significantly. That's basically my final view, that from the, and again, we are 50 stocks portfolio. So any effect on any company further reduces significantly. And that's what the advantage of, I would say, right diversification is all about, correct? So it creates enough cushions in the portfolio to make sure that nothing, a single company, any adverse impact doesn't necessarily mean huge impact at the portfolio returns.
I will add one more point to, on this discussion. If you look at, what US recently passed their budget, which is called Big, Bold, Beautiful, right? Now, the most experts are saying it will increase fiscal deficit and their debt to GDP. So while the US, the physical deficit is expected to rise further from 6.5%, 7%, and also the debt to GDP will rise. Look at India, what India has achieved. In fact, in the last budget, our finance minister very clearly stated that they want to bring down the debt to GDP. While earlier they were talking about physical deficit, which is well under control, and now they are focusing on reducing the debt also. So India, if you see the macros, while they have improved significantly, there is clear focus and actions, policy actions from the government to keep improving further. And US, if you see, it is deteriorating. So ultimately, the global investors cannot continue to miss this such a story where the macros are improving, micros are improving, and there's an earnings growth of 12, 13, 14, 15%, and valuations are reasonable.
Great. Thanks. The next question, again from Hina Nagpal. There is a Jeffries report that states because the inflation is so low, the nominal GDP will come down and profitability of companies will get hit. I feel that due to infusion of money, excess supply will be countered by increase in demand and we may not see softer prices overall. Is there anything I'm missing? Do you think their thesis could play out? Not
Yeah, we will not see softer prices overall. Is there anything I'm missing? Do you think? See, basically, what the Jeffries report, I've not seen full detailed report, but very simple thing what it's talking about is that because inflation is low, the nominal GDP growth reduces. Okay.
Yeah.
Now, when the nominal GDP growth reduces, the revenue also reduces. Okay. Now, when the revenue reduces, the operating profit margins may not go up, and therefore the profit growth also to a certain extent reduces. So what is very important to understand is that ultimately you need to compare class A versus class B. Let's say, for example, fixed income versus equity as an asset class. Okay? That's number one. So if the fixed income yield, let's assume hypothetically, becomes 1% in India, see interest rate become 1%. Because inflation becomes 1%. Then definitely nominal GDP growth will not remain at 11%. Yes. Because our real GDP growth is only 6%. So nominal GDP growth will become only 7%. So revenue growth will be 7% and profit growth will also come down to 8%. And then equity market returns will also become 8%. But then 8 against 1% if you put in fixed deposit. I'm being hypothetical, just to, giving an extreme example, trying to basically showcase that ultimately you need to look at your returns on equity versus the returns in a other comparative asset class. Second very important is all these are macro things. As I said, during last year, what is our GDP growth? Is about 5%, 5.5. If you look at the Nifty revenue growth last year is only 5%. Last year already Nifty revenue growth impacted. Nifty profit growth is only 7%. Correct? But we need to also keep in mind that in India, there are 1,000 listed companies which are good companies out of total 5,000 listed companies. And of that 1,000 listed companies, there are roughly 150, 200 really good companies with a market leadership, high ROE, and at the same time, they have a high earnings growth. And as a portfolio, as an active fund manager, what we do, we keep identifying such portfolio companies for a portfolio and construct them. So therefore, if you look at the Nifty earnings growth is 5%, 6% for FY25, our portfolio has delivered 20% plus profit growth. And therefore, while market gave you only 5.5-6% returns FY25, our portfolio delivered 14-15% kind of returns, 12 to 14% returns in FY25. So ultimately, it's all about the right stock selection. We cannot predict beyond a point what will be the aggregate revenue growth and all that stuff, because there are a lot of factors. There are commodities. If the commodity price goes down, everything comes down. Commodity price goes up, everything goes up. What we need to keep in mind is, can we identify 40-50 companies out of this list of 1,000 good companies which can deliver 15-18-20% revenue growth and 15-18-20-22% profit growth? Let me give, for example, one example like capital goods. In capital goods, if you look at L&T, Larsen Turbo, is growing at about 15-16%. But we do not own L&T. What we own is Hitachi Energy, which is growing at 40-50%. If you look at the HDFC Bank, the loan growth is 8%. But our largest holding is Cholamandalam, for example, which is growing at 18-20%. Our largest holding is a housing finance companies, which is growing at 18-20%. If you look at the two-wheeler sector, the Hero Honda growth is 3%. But what we own is not Hero Motors. What we own is TVS Motors, which is growing at 18%. If you look at the Sun Pharma and Dr. Reddy's of the world, their growth is anywhere between 7 to 9% for last 10 years. But what we own is companies like Ipca and Ajanta, which has been growing 1.5 times the Indian pharmaceutical market. So what is important is to make sure that we identify the right companies, which is a potential and the capacity and the capabilities to keep growing their revenue growth. And if they don't, we get out of them and identify other companies which are at the right point of their business cycles and change the portfolio. And that's what delivers the stronger, longer term risk adjusted returns. I hope that answers your question.
Yeah. And in fact, you answered a bit of the next question also from Mr. Abhishek Lal. His question I just read out. Yesterday, Mr. Donald Trump announced that certain tariffs will be imposed on the pharmaceutical sector starting from August 1st, with the possibility of significantly higher tariffs being introduced after 1 year. What's your view on this development?
Good question. I will answer in two parts. The first part is that entire pharmaceutical tariff of Donald Trump is focused on European players, because the branded products which are available in European market to their citizen, same branded products in US market is at different prices altogether. And Donald Trump doesn't like it, because he said that this should be cheaper for our US citizens. And therefore his focus is, please put tariffs on Europe so that you make a huge revenue, because those are the huge imports. Generics are not huge imports. Generic is a very small market. It is yet to become that big. So first of all, this is more to do with European market and less to do with the Indian exporter, number one. Number two, coming to let's talk about now India, how India is positioning. So India is basically generics market. In generics, you have only 2-3 players which can do this, India and China. So whatever tariff you put on India and also on China, the cost will go up to the addition of generics. Now, the sad part is that consumer cannot avoid buying tablets. You need, whether you require, paracetamol, whether you take branded or whether you take generics, but ultimately you need to buy paracetamol. You need to buy crocin. Now, whether you buy crocin or whether you buy generics, but you need to buy it. So there is a pass-through impact will be highest in pharma, correct? Because in pharma, it's not a discretionary spend, correct? It is a compulsory spend. So that is as far as the effect on India goes. I do not see too much effect, because most generics players, because of the significant price erosion in generics market in last 8 years, they have exited the market. And therefore, no new major capacities are coming up in generic segment. Also, the US FDA compliance has gone up in last 7 years. So compliance cost has also increased. And therefore, number of players have exited from US market as a generics players. And therefore, the competition is not going to be so intense. And therefore, the impact of tariff on Indian companies is going to be there. Definitely, there will be some impact, but it will be very, very limited. Coming second very important thing, how we are positioned. So in pharmaceuticals, like any sector, we divide the sector into multiple sub-segments. In pharmaceutical, the first segment is Indian generics companies, which are catering to US market. We have a zero exposure to them. Zero Sun Pharma, zero Dr. Reddy, zero Lupin, and companies like that. Our entire exposure is to the domestic pharma companies like Ajanta, IPCA. Our exposure is to CDMO companies like Suven Life, which is the biggest beneficiary of outsourcing, and to the domestic hospital business, which has nothing to do with the US generics player. So one is overall impact going to be very, very limited. So don't worry beyond a point. But anyway, we do not have any exposure, which have a huge exposure to the US market. We have zero exposure in our portfolio. So that's basically answer to your question.
Thanks. This ends to the this call. Just Rajesh, your last concluding remarks for the coming quarter.
But the coming quarter, I think my final view is that we remain bullish. Keep faith on equity as an asset class. Volatility will be higher. Treat volatility as your friend. Don't get disturbed by it. Use it to your friend if possible. Keep adding to equity as an asset class. After a very long time, in the last 10, 15, 25 years of my equity history, I have not such coordinated efforts by RBI, finance minister, and central government. It speaks a lot in terms of what they are doing in terms of the action to revive the Indian economy growth. There are many companies in India, like for example, Murugupa Group, for example, Dixon Group, for example, EMS companies, for example, HVDC transmission technology companies, for example, data centers, for example, airbags, for example, auto ancillary components, and many such opportunities and the segments where growth is significantly higher than underlying GDP growth. And these companies are going to deliver 15, 18, 20% plus revenue growth and profit growth. As a fund manager, what is our job is to keep identifying such excellent opportunities at the same time with a very, very strict eye on valuation and the disciplined exit strategy. So do not chase the momentum. Make sure, keep some patience and hold it for medium to long term. That's the only way to get the great returns from equity as an asset class.
Great. Govind sir, with the uh, last remarks from you, with this all geopolitical, many things talked about and expectation and all.
I think it is very, very clear. We have been saying and we have been very loud and clear. In fact, I will quote 8th April webinar where we said when markets were, the fear was at its maximum and we said that put lump sum. 8th April and 7th April,
Great.
the mayhem was there and you see what
Yeah.
has happened. Why this, the bullishness comes from us as Rajesh narrated so many drivers. Look at the confluence of all these regulators, government which are there. Look at what's happening globally, where the many other countries who were enjoying the fruits, they are getting more impacted. India relatively better place. Look at the micros of India, which are much, much better place relative to most developed countries and many emerging market countries, whether in terms of political environment, whether in terms of policy continuity, all are getting aligned. And finally, what drives the market is the earnings growth and the valuation, which is also there. Now, valuations are quite reasonable at 10 years average. But if you factor in the change in the composition of Nifty, which has happened in 10 years, then the Nifty is actually cheaper by 10%. Friends, I'm repeating, Nifty is actually cheaper by 10% if you factor in the change in the constituents of Nifty. And then after 1 year of consolidation of 5% earnings growth, now we have entered already 12 to 14, 15% earnings growth. So minimum return over next 2-3 years would be 12, 13, 15% compounded. And we strongly believe that with so many factors which are growth drivers, can the earnings growth and the returns from the market can be higher than 13, 14%? Answer is yes, it can be higher. So we are saying that now markets have consolidated here for 10 months. The peak was on 27 September 2024 and now we are mid July. 10 months consolidation happened. There is almost 10% time correction. 4 to 5% there is a price correction. So you are getting market 10-15% cheaper. And then if you look at Nifty composition, then 10% cheaper. And earnings growth are 13-14%. Where will you get all this combination? So from that perspective, we are saying do not wait. Please ask your investors to put money lump sum.
Great, great. In fact, in the during the discussion and your bullish remarks, couple of questions again popped up. So let's take those as well. Uh, Mr. Neeraj Thakkar, question from Mr. Neeraj Thakkar. Considering current market situation, since interest rates are coming down sharply, if you want to start with fresh capital, how do you invest full lump sum or staggered? In fact, that both of our director just now given the complete bullish outlook and all. So on behalf of them, I am just answering this to just go lump sum. The second question from Mr. Neeraj Thakkar, if you can share some insight on how did you identify Gabriel India Limited, the stock is the stock is up 80% in last 10 days because last 1 year stock has not done anything. Please enlighten us with your research process, how you got such conviction to hold. What was the trigger to entering this stock? Rajesh, sir.
Thanks for that question. So I think it's a very broad question, and okay, let me try to explain in a very in a capsule format that what we do for stock identification. We have a very simple but of course very effective approach, which is called 3M approach: market size, market share, and margin of safety. We have identified 40 to 50 subsectors in India where there are only a handful of companies in the sector, which gives them oligopolies and monopolies. And then oligopolies means better pricing power, better profitability, less leverage, low borrowings, high ROE, high ROC, high reinvestment, and high growth. It's a virtuous cycle. Once you follow this approach, what happens that your drawdown during bad times is very low. So you protect capital. But of course, just buying leadership doesn't help to create wealth. For wealth, you require growth. So we buy market leaders with an under-leveraged balance sheet, provided it has a strong earnings growth potential. A company which Neeraj has talked about, it is a company which fits into the industry which is called a shock absorber industry. It's a very unique industry, friends, where there are top three players, Gabriel, Munjal, and Endurance Technology. They roughly command 70 to 75% market share. So 3M approach, market size is huge because it is in the auto component industry, and Gabriel is owned by Anand Group company, and Anand Group has a huge presence in the entire auto component for last so many decades, and one of the best name in the auto ancillary space. So that is first M, size of market, huge. Second is market share. It's an oligopoly. There are only three players in the sector. It's an undisputed leadership within the sub-segments of truck industry and then passenger car, and is the third player in two-wheeler segment. So market share. And third is a margin of safety. Company has a zero debt balance sheet, and over last 3, 4, 5 years, company has kept reinvesting their profits. And in fact, last 1.5, 2 years, it entered into a new segment, which is a sunroof segment. Now, this is very interesting case because companies by till now, few years back, was largest player in shock absorber. And all of a sudden, they entered into a new segment, which is a sunroof segment. But here too, it did a very strategic thing by doing a joint venture with a player who is a globally number 2 player in the world. He's a Korean player and 100% supply to the entire Korean companies, Hyundais and Kias of the world goes from that company. So Gabriel did joint venture with that company. By doing this joint venture, what you did two things at one action. One, you got customer ready customer. And second, technology ready. Ready technology, ready customer, your payback period comes down to less than probably 3 years because your entire offtake is ready to be sold to a single largest customer, which is called Hyundai and Kia. So that's what they did. And then because Anand Group is a very big group, and during last, I would say 3 years, 4 years, 5 years, if you look at the Gabriel performance in terms of the revenue growth and profit growth, it has been always better than the underlying industry growth, which again talks about how competent the company is to grow their revenue and profit growth higher than the underlying industry growth, resulting into the great wealth creation. Last but not least, what happened in last 1 month and why the stock went up? Because Anand Group, which is a presence across the multiple their own unlisted companies apart from Gabriel, has decided to do a, I would say, shareholder-friendly merger of few of their unlisted entities into this listed entity, which is called Gabriel. And it is so shareholder-friendly structure that it is almost 30% plus EPS accretive. I repeat, 30% plus EPS accretive transaction for Gabriel minority shareholders. Friends, I remember my earlier experience with Uno Minda, which was earlier called Minda Industries, and stock went up almost, I think, 10,000% in last 12 years with a 35% compounded annualized revenue growth and 36% compounded profit growth. It has been our top holding in our AAA IOP PMS as well as in AAA Budding Beast for last several years. Anand Group did something similar, just like what Minda did. Because Minda also had many unlisted companies, associate companies. They merged all these companies at a very favorable valuation to the Minda Industries, resulting into huge wealth creation for Minda minority shareholders. Same thing happened with the Anand Group, and that's what they did. And I think that's very shareholder accretive transaction. That's why the stock is up. Of course, nobody can predict such events, but the important is if you buy the market leader, if you buy the under-leveraged balance sheet, and if you buy the good promoters with the right governance, and that's what the governance, very important, correct? If you buy such promoters who are always shareholder friendly, who will at least make sure that they don't do anything against the minority shareholders, you will be rewarded in the long term. That's basically the stock selection process, what we follow. We do a lot of on-ground research. We do a lot of governance research. We do a lot of forensic research before we buy any business. And then, of course, when such promoters do this kind of a corporate action, of course, it benefits all of us as a minority shareholders. So I hope that answers Neeraj's question.
Thanks, Rajesh. With this, would like to conclude this call. In fact, thanks everybody. Thanks Rajesh. Thanks Govindji, and thanks entire all our partners and supporters. Thank you. Take care. Happy investing.
Thank you, friends. Thank you. Bye-bye.